What's going on, YouTube fam? This is the Wealth Investing Network. We do this for the win. You're getting a sneak peek into my stock portfolio and a sneak peek into my research on stocks. We've got a lot to cover today, talking about Chargepoint and BLNK charging. So please hit that like button and subscribe because I want to jump right into it. Now, we've talked a lot on the channel before about how these companies peaked right at the end of 2020, beginning of 2021. Their stock prices topped out at about the $40, $45 range. But of course, more important than the stock price is the market cap. BLNK charging is sitting around $1 billion at the current time, and Chargepoint is sitting around $5 billion at the current time. The market cap is essentially what Wall Street thinks these companies are worth or valued at. But not only that, we know that Chargepoint has close to 200,000 activated ports, and we know that BLNK charging only has about a quarter of that number of chargers deployed or sold. They're also mostly in the US, while Chargepoint has a better mix internationally, primarily being in the United States and Europe. But BLNK charging is trying to increase their count. They recently acquired SemaConnect, which was one of their bigger competitors, actually. The headline to me was that they acquired them for $200 million, and that it's a cash and common stock transaction. And I'm going to say right up top that I need to look more into how they were able to do this transaction with common stock, because this is not a business that's flushed with cash. And so if they're doing a $200 million stock deal, they don't have the cash to do it. Their market cap is about $1 billion. What does that mean for shareholders when it comes to your slice of the pie being cut into many pieces? But this deal does quite a few things for BLNK charging. It sets them up to gain 13,000 EV chargers, an additional 3,800 site locations, and more than 150 registered EV driver members. Now, I'm still not sure exactly what that means. It could be comparable to that roaming integration figure from Chargepoint. And it's interesting to try and even keep up with these companies because they're growing so rapidly and their number of ports, things like that. Chargepoint recently acquired a company called Has2B for close to $300 million in cash and stock. And through that deal, Chargepoint gained more than 40,000. So it's clear that these numbers are very important for them because they're really trying to establish dominance. I would say that Chargepoint is the leader right now. But of course, it depends on what matters to you and what levels these are. I don't know how complex I want to get here, but Chargepoint mainly deals with level 2 charging, which to get a full charge, it takes more than 3 hours, depending on how big your battery it is. But at this point, it's the most cost-effective way because DC fast charging, which the benefit is it takes about 30 minutes to get 80% charge, depending on how big your battery is. It could cost up to $50,000 to install a charging station. So again, these numbers are very important to these companies. That's something that investors look for. But there's a couple things that I like to focus in on, and that's the dollars and cents of it and the quality. One thing that BLNK charging seems like they might benefit from more in the US, the Biden administration's Buy American mandates and the infrastructure bill and things of that nature could benefit BLNK charging because it seems that most of their chargers are made in America. I don't think that's the case with Chargepoint because I've seen how lockdowns have affected them. They talk a lot about global freight costs, and because so much of their business is in Europe, I don't think they'll be able to benefit from some of the same things that BLNK charging will, but I do think they will be able to benefit because they're a leader in the space, probably the leader when it comes to level 2 charging. And it's going to be interesting to see how all this shakes out because companies like EVGO are only focused on DC fast charging. Chargepoint benefits from having a capital light model because they cooperate with businesses who serve as hosts for their chargers, and they're able to sell them the chargers and the software, while EVGO is a capital intense or heavy business where they own and operate everything. They sell the electricity. Volta's also building their own and selling electricity, but also selling ads on top of that to make it free in some cases, but that's just a whole different business model. Again, I like that both Chargepoint and BLNK have multiple business model options. They have some that they own, some that are completely host owned, some where they have it as a subscription or as a service. In terms of charging stations, they're trying to meet people where they are. I think both Chargepoint and BLNK recognize that most people charge their cars in their house, so they're selling residential charging. But another way to view that is that they're just all over the place, and this is very complicated. Again, there are some things that I don't understand, how BLNK claims that there are more than 400,000 drivers in their network. The whole battle going on in the EV charging industry kind of reminds me of the streaming wars in the sense that each company has their own things that they want to highlight that will make them come out on top. But at the same time, you kind of see them start to cannibalize each other, and you start to see that any mistakes they make are really, really costly. I think the same could be said for the EV charging space because there's so much competition. And as investors, we have to be very careful in terms of what's actually working for these companies and what's actually them just peeing in the wind and making a mess. I do think based on the sheer volume that Chargepoint has, this is an app that if you have an EV, you're going to need this app on your phone. Unless perhaps you have a Tesla. In that case, Tesla might be the only app you need to have on your phone. But if you don't have a Tesla, you might not be able to utilize Tesla's over 25,000 supercharging stations. I don't know. I don't have all the answers for you. I did find this article where JD Power surveyed close to 12,000 EV owners. They measured customer satisfaction with EV charging on a 1,000-point scale, and satisfaction is actually dropping. And the general satisfaction is around 633 out of 1,000. DC charging remains a little bit higher at 674. Tesla actually had the highest rating. Volta came in right behind that, then ChargePoint, then SemaConnect, then BLNK. And that's among level 2 charging. Among DC fast charging, ChargePoint actually came out pretty well. So when all this money starts coming in from the government, are they only going to fund DC charging? Are they going to be more favorable to companies that customers like? Because in general, it does seem like EV owners are fed up with broken EV chargers and janky software. The first time we talked about BLNK, there was a short seller report that indicated that most of their chargers didn't work. I do think they've improved since then. Now check this out. When you go to BLNK Charging, you can look at their share statistics. And BLNK Charging's short interest has been high ever since that report came out a while back. People still want to bet against this company. People still think it's way too overvalued. And basically the same could be said for ChargePoint, as their short interest is well over 10%. But those are some of the things that I look at in my research. I highly recommend you do your own research because I'm not a financial advisor. We've talked a lot about these companies, but I want to talk a little bit more about the stocks. The blue line is where the stock price is, but the black line is a simple moving average, and this is the 200-day. I like to look at this because this shows you where the trend is going with this stock. So if you're trading it, you want to see an uptrend like it was in 2020, but now you see the stock keeps hitting its head on this 200-day moving average, and the downtrend remains. You want to see it break above and stay above if you really want to ride it for the long term. Or you could try to ride some of these deep pockets that happen in between. But switching over to BLNK, it's basically the same story, but these stocks trade a lot based on news. And of course, I like to do my own breakdown in terms of red and green flags. Obviously, the shares outstanding can be a big red flag because like I mentioned with these companies' huge acquisitions that are in cash and stock, that is if you're a shareholder, think of your shares like slices of a pie. And when they decide to make acquisitions that take up a large percentage of these companies' actual market cap, well, they're going to be slicing your shares of the pie to shreds. That's why I have these plus signs here. The shares outstanding were much smaller when we first started covering these companies, and you can check those videos out if you'd like. And when there's any indication that this share dilution might stop, that might actually be a good time to get into the stock. Another good indicator might be when they're a little cheaper from a price to sales ratio perspective. You obviously want these numbers to be as low as possible. The average for the S&P 500 and top tech companies is really in the range of 2 to 2.5. If you're a really high growing company, people are willing to pay more of a premium, but there's also a limit to that and how long a high valuation for a company can last. Revenue growth is where both of these companies shine. ChargePoint is essentially on pace to double their revenue every year. Before too long, we're going to see them reach $1 billion in revenue. But where will their market cap be at that point? For BLNK, even if they triple every year for a few years, they might still be expensive from a valuation perspective, which is something to think about, especially when these companies have hugely negative margins. To have a negative 200% profit margin means that not only did they spend all of the money they made, they spent $36 million and then spent that again and again, basically twice over to have a net income of negative $72 million. But I like that they have $85 million in cash and almost no debt. That's a very positive thing. But how long is that going to last at the rate that they're spending money? And I said the same thing for ChargePoint a few months ago. And around the time I made that video, they ended up taking out $300 million in debt. And debt essentially is not a problem until it is. Until paying it back hurts your margins so much that it cancels out your growth and cancels out some of the positive things you might have going for your company. But all in all, I like the position that ChargePoint is in, clearly a leader in the industry, and I like how quickly BLNK Charging is growing. When we first started talking about BLNK, I believe they have $5 million in revenue, and now they have $35 million. So with both of these companies, you're going to see revenue growth, but does that match up to what the stock is doing? Probably not. And that's because these companies basically trade on news. So definitely keep that in mind. And hey, you might not agree with me. If you don't, let me know in the comments. If you have an EV and you've used any of these companies, I'd really want to hear your opinion. And you can always just leave me a comment to say, hey, in fact, I dare you to. Say hello. If you made it this far in the video, I want you to know I really appreciate it. hit that like button and subscribe. I've got to go cut the grass. See you in the next video.